Tomorrow's hearing has 3 panels, and our next guest is on the 3rd and final one, which focuses on the economic impact of the financial crisis. Mark Zandi is the co-founder and chief economist over at Moody's Economy.com, an economic research firm. He was an unpaid advisor to the John McCain presidential campaign, also assisted with President Obama's transition team, and he joins us from Westchester, Pennsylvania. Let's get right to it. So, Mark, you're going to be on this panel. They're looking at the economic impact from the financial crisis. What points do you want to stress tomorrow?
Well, 3 points. First, obviously, the Great Recession was a direct result of the financial crisis. Now that's over, and that gets to point number 2, the recovery, the current recovery. It's fragile. We're making progress, but very tentative progress, and that too is related to the financial crisis, the credit crunch, the loss of household wealth, the impact that this is having on confidence. And then the third point is, and perhaps the most important point, that this financial crisis is going to have long-term economic consequences: lower GDP, lower employment, higher unemployment rates for an extended period, and of course our very dark fiscal situation. Those problems are now closer at hand because of the financial crisis.
Hey, you make a point in your executive summary that the jobs picture is stabilizing, and you make it right up top. Is that one of the most important elements to this economic recovery? Do we need to see jobs stabilize before we can see the economic recovery really take hold?
Well, Matt, it's the most important thing at this point. If this recovery is going to evolve into a self-sustaining economic expansion, we need to see businesses begin to hire. Now, they reduced their layoffs. Layoffs are abating, and thus the job losses have lessened. But we're not going to get job growth, and that's what we need for this thing to move forward, until businesses hire. And so far, that hasn't happened. Now, I think that will happen, but we need to see it.
Mark, let me ask you, though, we talk about all the stimulus money that's out there. Isn't there still an awful lot of stimulus money to come from the government? Won't that kind of help jumpstart things and maybe get companies to increase their hiring?
Well, stimulus is helping, both monetary and fiscal stimulus, but the maximum benefit from the fiscal stimulus actually was last summer and fall. The key link between stimulus and the economy is the change in the stimulus spend out. So we went from no stimulus at the beginning of last year to $80, $90, $100 billion a quarter by the end of the year. It's that change that really matters. Now, we're going to stay at $80, $90 billion a quarter into the mid part of this year, and then it begins to fade. So, in fact, by the end of the year, unless there's more stimulus provided, last year's stimulus package will become a drag on the economy.
Do we need more stimulus to guarantee that we don't have another recession in the economy this year?
You know, I would provide more stimulus, yes. I would provide some more temporary tax cuts and some temporary increases in spending. It doesn't have to be nearly as large, but if we provide another $150, $200 billion to the economy this year in calendar year 2010, then I think we will ensure that this recovery evolves into an expansion. And in most normal times, I wouldn't argue this. I think it would be a mistake. You know, even in most normal recessions, I wouldn't argue this. But if we go back into recession, it's going to be a complete mess. I mean, the unemployment rate is 10% and going to rise, and the funds rate's at 0. We already have a very large deficit. So we need to make sure that we don't go back into recession.
And Mark, that's what I thought was interesting in your note that you sent to us, is you talk about recession risks being kind of at their highest during this period. You're talking, I think, about mid-year. I mean, you're not ruling out the possibility of us possibly going back to recession, or are you?
No, I'm not ruling that out. I mean, I think the probabilities are less than even, are probably 1 in 5, 1 in 4, but that's too high, particularly given the fact that if we do go back into recession, we got a problem. So, and there are many issues that we're still grappling with. I mean, I mentioned the credit crunch, the foreclosure crisis, what's going on in commercial real estate, the fact that state and local governments are hemorrhaging red ink. There's a lot of weights and risks to the economy. The coast is not yet clear.
Are there risks, though, to too much stimulus? I mean, you point out that the Fed is nervous about the possible inflationary implications of that. Are there, though, serious risks as far as inflation is concerned?
No, not in the near term, no. I mean, I think with a 10% plus unemployment rate, the fact that labor compensation growth is slowing and under some circumstances could even begin to decline, I think there are no prospects for accelerating inflation, certainly not in 2010, not in 2011. Now, if you said to me 2012-13 inflation may begin to accelerate because the Fed doesn't land the plane right on the tarmac, I say that sounds about right, but let's get there. And I don't think there's any reason to be conducting policy today based on inflationary concerns in 2012 and 13.
You know, we've been talking throughout the last hour or so, Mark, a little bit about kind of the regulatory frameworks as well. We talked with Ed Yardeni, and he thinks there's going to be basically gridlock in Washington. And so, you know, not a lot of changes are going to come down the pipe. Do you agree?
Well, that's certainly a possibility. It is an election year, but I'm hopeful. I do think we'll get financial regulatory reform this year, at least some parts of regulatory reform. And it would be a travesty if we don't get it, because if we don't get it this year, we're not going to get it. And everyone agrees that the financial system did not work properly during the crisis. And unless we make changes, the risks of another financial crisis down the road are high. So we need to make those changes, and hopefully we find the political will to do it. And hopefully the Financial Crisis Inquiry Commission that begins hearings tomorrow, as you mentioned, will be the impetus for getting the political will to make those changes.
Why won't we get it at all if we don't get it this year? I mean, you say in your paper, if heightened policy, or I'm asking, if heightened policy uncertainty created by debates on health care, financial regulatory reform, cap and trade, taxes, these are all problems that you say deter hiring. If that's the case, why don't we just put this stuff aside until we get the finances straight, until we get the economy in order, and then go back and worry about cap and trade? I mean, why do we have to do it now in the middle of a crisis?
Well, what I would recommend is let's nail down health care reform. Let's nail down financial regulatory reform this year, because those are things that we can get done and we should get done. And if we do get into next year and haven't passed financial regulatory reform, I don't think we'll do it, because everyone will think the coast is clear. There won't be the political will to do it, and our opportunity will have passed. Now, in the case of energy policy, yeah, I see the case for taking that ball out of the air, waiting. Let's get to the next side of this election and then decide what to do there. But regulatory reform, I think we need to do it now.
Hey, Mark, just 20 seconds here. Bottom line, you say we're doing better than we were a year ago, and a year from now we'll be doing somewhat better as well, correct?
Yes, I am inherently optimistic, and I'm optimistic in large part because I think the private sector is going to step up, and I also think policymakers are going to remain aggressive enough, long enough, to make sure the recovery evolves into an expansion.
All right, we got to run. Hey, Mark, thank you so much. Mark Zandi, the chief economist at moody'seconomy.com.